Retirement Cafe podcast, the 9 accelerators for a successful retirement, a well-crafted investment. Hello, and welcome to another episode of the Retirement Cafe podcast with me, your host, Justin King. If you're thinking about your retirement or already retired, you're in the right place. My aim is to help you plan for and live a successful and meaningful retirement. Retirement is far more than just a financial event. It's a significant life event, a major transition, which will bring with it new challenges and opportunities. So each episode contains tips, information, and inspiration to help you feel more informed and confident about your retirement. I hope you enjoy today's episode. Hello and welcome to the podcast. This week we return to our series of the 9 accelerators for a successful retirement. If you've missed the first 3 episodes, check out the show notes for this episode on our website, retirementcafe.co.uk, or on your preferred podcast player where you'll find more information. If you've been following this series, you'll probably know by now that when I'm not recording podcasts, I run a retirement planning business, MFP Wealth Management, helping people retire successfully. And over the years, I've helped dozens of couples plan for their ideal retirement. And during this time, we've created a framework for what we believe needs to happen for you to be able to retire with confidence, clarity, and choice about how you spend your retirement. We call this framework our Retirement Success Program, and it contains 9 accelerators. These are the areas of planning we consider when helping our clients plan for their next stage of life. So let's recap briefly on what we've already discussed. We've covered the importance of identifying your priorities for your retirement, which is about how you want to spend your time and money to create a fulfilling retirement. We've discussed the benefits of creating a lifetime financial forecast. And most recently, we chatted about minimizing lifetime tax. This week, my wife and business partner, Kathy, returns to the interviewer hot seat as we discuss a well-crafted investment. Welcome back to the podcast, Kathy.
Thank you. It's great to be back.
Right. I'm ready for your grilling.
Okay, so investing. So obviously investing is a huge part of what we do for retirement planning. So tell me, why is investing such a crucial part of retirement planning? Why is it so important?
Well, over a 30-year period of retirement, which is what a lot of retirees can now hopefully expect, the silent killer is inflation. And, I often talk about, if you took £100 to Sainsbury's or Tesco's or the supermarket of your choice today, and you continue to, you'd better get a full shopping trolley of goods. And if you continue to do that for 30 years, took £100 every year, by the time you get to that 30th year, I reckon you'd have a very small shopping basket that you'd be able to fill up, purely because, of course, the cost of your supermarket goods will get more expensive over time. We've seen that, the price of fuel, the price of a stamp, the price of a pint of beer, what have you, they continually kind of rises. And therefore, your spendable income, if you've got that money in a deposit account and you're earning at the moment kind of 0.25%, 0.5%, 1% if you're lucky, that it will in essence be eroded by the value, by inflation growing, and therefore somehow we've got to counteract that. And that's when we get to investments.
Okay. And I guess, one of the things that we know from the people that we work with, they're very aware that when they stop working, there is no other way unless they go back to work, but generally there's not that opportunity to earn more money. So that what they've got is what they've got to make it last.
Yeah. And we know it's a huge pivot point, don't we? We know it's a massive transition. Suddenly the reliance on your skills for earning your money has now to the point now gone, in essence. And we know it's there if they wanted to return to work, but we all lose our kind of relevance, I suppose, in our workplace. Once we've retired, we may be able to get back into our workplace 2 or 3, 5, 7, maybe 10 years later. But, the reality is, if you're not connected to most industries and professions nowadays, you lose your kind of connectivity and your relevance and the equity that you hold. So therefore, you've amassed a pot of money. You want to make sure it lasts. And of course, it's a huge concern, isn't it? Have I got enough?
It's massive, isn't it? It's massive. So we're going to talk a little bit more about kind of two different aspects to investing in retirement. So we are going to come on to talk about investing for retirement, and then we'll talk about investing in retirement. But maybe first you could just give us a bit of an overview on investment risk. Talk to us a bit about investment risk, because it's I think it can be quite confusing.
Yeah. So investment risk, it's an interesting one, because as soon as you say the word risk, I feel that what's risky to one person is not risky to another. I suppose an expert tightrope walker walking a tightrope, he would go, "This is not risky," but to you and I would go, "Oh my God, this is just nuts. That's risk." So of course, there's an element of what are we experienced in, what are we knowledgeable in, and how do we apply that knowledge to risk? Again, to give you another analogy, to you and I who drive cars, getting in our car, we know hopefully it's got a relatively low risk. We drive sensible cars, they're well protected, and as long as we kind of obey the rules of the road and stick to the speed limits and be aware of our kind of surroundings, we know hopefully there's a low level of risk of us having an accident. And even if we do, we know it's repairable, hopefully, mostly. Now, I appreciate that you can have, there are kind of those black swan events where we have significant motor accidents or can be caused by somebody else. But most of the time that we know that we can, go and pick the kids up from school and we should get away with it. We should be okay. So if we then go, right, now I have a motorbike license and you don't. Now I would say it would be a riskier thing for you to do to get onto a motorbike today than me.
Absolutely. Wouldn't know where to start.
Absolutely. But I also talk from a point of position where I had a serious motorbike accident, nearly lost my life. Now, therefore there's more risk attached. So just because I've got the skills and I'm able and competent to ride a motorbike, I couldn't do anything about the guy who did a U-turn in front of me at 30 mile an hour. And we know the story. He got sadly got done. Well, he got done for dangerous driving. It wasn't my fault, but I couldn't deal with that risk. The only way to deal with that risk was not to get on the motorbike in the first place. But that, coming back to investments. So what is risk there? Well, first of all, as I say, the inflation risk, the risk that your money won't keep in line with inflation. So actually we need to do something do we need to do something about that? Our cash flow model will look at the scenario of, is there enough? Now I can run that model on the basis that we get zero return, but carry on getting 2 or 3% inflation. Actually, showing my geekiness here, since around about 1950, the average inflation in the UK has been 5.7%.
Wow, that's higher than I thought it was.
Absolutely. No, it would, because of course what happens is we get a recency bias. We know that inflation it currently is, I don't know what it actually is, but it's a couple of percent. It's kind of been low for quite a period of time. So we just remember what's been low. Most people don't remember interest rates being, well, our retired clients will remember interest being 13, 14%. But we had significant inflation at the time as well. In the 70s, with 3-day week and the oil crisis, we had rampant inflation. If you live in Brazil or Argentina, you would often, it'd be the norm to expect inflation of 20%. So if you have a well-crafted investment portfolio, which is designed to counteract inflation, and to show historically I mean, we can only base it on historics. What was the investments done over a period of time? Now, the stock market, i.e. the equity market, the global stock market, has served individuals, companies, corporations very, very well over a long period of time. The returns that have been provided by just holding a well-diversified global equity portfolio, we've counteracted the inflation risk, and we provide a significant return above inflation over the long periods of time. So what we have in there, we have volatility. So we have ups and downs of stock market prices, significant shifts from the price today to the price tomorrow. We saw when the pandemic reached its kind of real crisis last February, March time, we saw a significant volatility in the stock markets, declines, I think, of up 25, 30 odd %. Now, for the investor who sat through that, so I was just to give you a point of perspective here, I was advising a client this morning and we were reviewing their investment portfolio. Now, from this time last year, so it's the 30th of April we're recording this, their portfolio was up 35%. 12 months on 12 months. Now that's significant, but it's smoke and mirrors. It's not really it's a classic statistic without the kind of proper framing around it. When we looked at the annualized return that they'd received over the last 2 years since they actually invested with us, their annualized return was 10%, or just shy of 10%, at 9.65, I think it was. So if you then put that into the backdrop of a couple of percent inflation, they're getting they've received a 9% return. They've 7% over and above inflation. We're already well on track to beat an inflation-linked return. What I don't want to do, though, they also sat through the volatility. So when the market fell by 30 odd %, and they saw that decline in their portfolio, they were well behaved. They controlled their emotions through guidance through myself, and they sat there and they went, Justin had told us about this. This was expected. There are significant periods of volatility. To get the higher expected return that the market has historically provided, you have to sit through those periods of volatility. Now, a lot of people will call that risk. When the market declines by 30%, oh my gosh, look at the risk. Historically, and again, I can't promise this is going to happen in the future, but historically, if you hold a global equity portfolio for a long period of time, and when I'm saying long periods, I'm talking 10, 15, 20, 25 years time frame, you get rewarded for the patience that you demonstrate. If you get emotionally attached to the downsides of the market and the upsides of the market, then you start to react to those events and try and time it and try and make decisions around what you're hearing from the media, what you're reading in the newspapers, from your investment magazines that you can buy. And this reaction could serve you well, but in my experience, it doesn't. You're better off just getting this well-crafted investment plan in the first place and sticking to it, whatever the market is throwing at you at whatever periods of time. So my clients this morning were ecstatic with the returns that they've received over the last 2 years, but I counseled them to go, I'm still expecting 2 or 3, maybe 4% above inflation over the long term. So we're significantly over that at the moment. So we've put some fat in the bank. Let's just see what happens. Expect the next decline. Historically, we've seen declines of up to 15% every year in the stock market. It's normal. When I say within year, intra-year, declines of 15%, you have to go, okay, this is normal. And 4 out of 5 years tend to be positive. But I don't know which 4 out of 5 years have been are going to be positive. I just know historically that's been the case. So I have faith in the future. I'm optimistic about returns going forward. I believe that they will still continue to deliver an inflation-beating return for the investor who sits in that well-diversified portfolio for the long term.
So, I mean, that's really interesting. There's a lot of stuff in there. So, but one thing that jumps out to me, it feels like one of the biggest risks in investing is ourselves, is the investor behavior, or whatever the right terminology is. It's our emotional response when, understandably, but it's our emotional response when things become difficult, when the market drops or when it's a bit volatile or whatever it might be that's going on.
Well, we're emotional beings, and we all know that the most, coming back to my kind of car driving analogy, the most mild mannered of us get irate when something's happened on the road, and I sometimes wonder. I think, I'm sure you're not normally like that as someone's. I was riding my bicycle the other day, and a car drove past and leant out the window and gave me a sign. And I was thinking, well, I mean, I have no idea what it was about, why it may have been a woman, but there was obviously hatred of cyclists. I don't think they've been stuck behind me for a long time. I don't think I was riding in the middle of the road. I just think they just wasn't a fan of cyclists. And then you think, even if I actually met that person and shook their hand when you could do that, if we were meeting at a party, I bet you'd find that they were very pleasant and very mild-mannered. And something happens when, I don't know, when we get into cars and, our emotions shift. And that's the interesting thing, I think, around money. And money is, what is money providing? Well, it's providing security, isn't it? What's that feeling of security? That feeling of like, I'm okay. I've got enough. It's all right. I don't have to go back to work if I'm retiring, or can I afford to retire? So many people have said over the years, it was that moment that I said, what, this is affordable now. You're going to be okay. As far as I can tell, you're going to be okay. I've done all the planning. I've done all the cash flow modeling. I've looked at all these areas of retirement that we're looking at in the podcast. And, I can't guarantee anything, but it based on historical evidence, it looks like you're going to be okay. You're not going to be going back to work, or if, pushing a trolley at B&Q. I mean, I appreciate some people enjoy that. That's a job that they want to do in retirement, but I want that to be a choice, not a necessity. So I think emotions, are significant in this. And it's really odd, isn't it? We're told throughout most of our lives that if we work really hard, we'll do really well. Bizarrely, with investing, in my experience, it's not about hard work. It's about this well-crafted investment plan and then kind of leaving it alone. We do some rebalancing. We do some kind of tinkering around the edges. We do some tax planning. We make sure that we're paying as little cost as we can. We're doing some stuff around that well-crafted investment plan, but it's a bit, again, I have another analogy. We're planting a forest. And if you were planting a forest, you wouldn't go and pull up those trees every 6 months to see how they were getting on. You would probably plant some pine and some beech and some alders, some oak and some fast-growing trees and some less fast-growing trees and trees that you can crop and trees that will be around in 100 years. You'd just diversify it, but you wouldn't pull it up every 6 months, 12 months and go, you might plant a bit more over time. You might kind of go, well, we'll use that and we'll do it. There may be some reasons, or we'll give part of the forest to the family and they can look after it and put that bit in a trust. There's some kind of strategies that you would do, but the actual fundamental thing of what we've got invested, we would just let grow. We would let nature take its course. And that's what we're really doing, is we're letting capitalism take its course.
Great. Yeah, great. No, that all makes a lot of sense. And, when you're talking about what does money provide to us, it's about security, isn't it? And it's when we fear that security is under threat that we respond emotionally, don't we? Which is completely understandable. Which is why working with an advisor who's able to kind of hold your hand through that, I suppose, can be really beneficial. And I think there's data out there, isn't there, to prove that people who invest with a financial advisor, with a qualified financial advisor, generally get about a 4% better return on their investments over time than those who go alone, because of the support and the ongoing, reassurance that stick with it.
There is that data, and I think it's absolutely true. But of course, it's only true for some people. And it is coming back to the car analogy. There's a whenever I've been in front of a lot of people in a seminar, and I can ask the question, who would in here would put their hand up if they were an average or better than average driver? And most people will put their hand up, and you kind of go, well, how can that be right? Out of the 300 people in the audience, how can 250 people be average or better than average drivers? There's a whole lot of stuff going on, isn't there? So we feel that we can. I think a lot of people feel that they will be okay, and it is all okay when the market keeps rising. Mm. So it's been able to deal with the difficult stuff, isn't it? And if people can do the difficult stuff on their own, which I'm absolutely sure they can. There's no reason that they need to have someone like us, but some people would prefer to have someone like us. And that's a choice everyone should be able to make is first of all, can I trust myself emotionally when it starts going horribly wrong? Do I want to spend all my time considering this stuff, working out the strategies, the right analogy is the right trees to plant, which ones we're going to cut down this year, which ones we're going to plant a different crop. What are we going to do? Are we going to continue tend to it? Are we going to make sure we don't pay too much tax on it? All those types of things that where we are adding value and making the selection, the other thing that I don't want to promote, I suppose, but there is a benefit of advice is that, as you know, we pay an awful lot of money on professional indemnity insurance. We pay an awful lot of money to the FCA to be regulated to do what we do. We spend an awful lot of money paying our financial services compensation scheme levies to protect people in the event of them buying something, buying a pup, an unregulated an investment that they shouldn't have bought. So you get a lot of protection from a regulated financial planner or financial advisor. There's a huge amount of protection built into the system, which is great. So, which is where it annoys me when I see people buying investments which are from unregulated firms or from firms that aren't regulated by the FCA, and then the liability falls on us guys to bail people out. That's a bit frustrating. So I think not only should an advisor be able to put a well-crafted bespoke investment plan together for a couple or a client, which fits their plan. It's got to fit their specific circumstances. What's their age? What is their risk profile? What do they want to achieve? What's their health like? What are they? All those things, other things we've been talking about. But also the advisor, if they get it wrong, you've got some compensation, you've got some opportunity to go, sorry, this is, whereas you do it yourself, you're cool. No problem. You might save a bit of money on fees, but it's your call. You are the one who's ultimately responsible for the decisions that you took. And not the advisor. So, there is some levels of protection with an advisor. It's that there's some counsel, hopefully, some wise counsel, some thought process in there. And I think the feedback we've had, hasn't it, from our clients is that they enjoy the different perspective that I bring to the table. It's not their perspective, so I can challenge their ideas and I can give a different way of looking at it. So we've got some clients who are, they're pretty darn clever with investments. They know what they're doing. They're running PLC companies. They've been captains of industry. They're X this, X that, etc. But they're still seeking my thought process around this stuff because they understand a different point of view is worthwhile. They can listen, even if they don't take my point of view, they've listened to a different perspective.
Yeah, absolutely. Okay, so I wanted to touch a little bit on things to consider when you're investing at different kind of stages of life. So what are the kind of things that people should consider when investing for retirement as opposed to investing once you're retired? What are there some different factors to consider, or do you see them being all the same?
No, I mean, what a massive question.
I know there's a lot in there, isn't there?
Yeah. So just hopefully trying to be as succinct as possible. The key here is in your 20s and you get auto enrolled into a pension scheme, or if you don't get into one, contribute as much as you can darn afford. In fact, there's an element where I think that you should possibly contribute. You should save, whether it's just in a retirement plan or a different plan, but you should save to the point that it's slightly uncomfortable.
Mm.
You know, and if it's slightly uncomfortable, you've probably got it right.
It's a challenge, though, isn't it? When you're in your 20s, it's very difficult to see, to really believe that you'll ever retire one day.
Yeah.
It's a challenge, which is part of the thinking behind the auto enrollment scheme, isn't it?
It is. There's a danger with the auto enrollment is that the people think it's enough, and it's probably not. But to try and do that, but then equities are again, I said it a few times, but a diversified, low cost, equity portfolio over the long term has served many, many investors very well. Look up the data, learn a little bit about it, and go, do you know what? What have I got? If I'm in my 20s, if I'm in my 30s, and again, this is a shift, I think, for many 60-year-olds who come to us. They've possibly got, with a couple especially, they've possibly got 30 years ahead of them. Mm. Well, that's 30 years of inflation eating away at your money. So maybe 30 years of maybe increasing your equity exposure could be the right solution.
Particularly when you're young, when you're not going to access that money for 40 years, 30, 40 years as well. Yeah. There's a lot of benefit you can get from taking that approach, can't you? 100% equities or really high level of equities.
Absolutely. Again, we've got to only talk historics. We only know what's happened in the past. We don't know it'll happen in the future. It could be that bonds are the best thing to do over the next 25 years. I very much doubt it. By buying shares in well-run companies of the world, we have about 11,000 different companies in our portfolios. But buying into those companies, you kind of go, the companies are all about progress. They're all about a new product, a new way of serving people, a new thing that they're developing, and you become shareholders in those companies. We have a little bit of Apple, we have a little bit of Amazon, we have a little bit of Tesla, but we don't own enough of anything to get us killed.
Yeah. So
we're never going to make a killing for you. We're never going to have 100% in Tesla or Bitcoin, which is done, some crazy amount, etc. I'm sorry, but we're not going to do that. But if you think about what we're really, really trying to do, for most people, we're trying to provide security of income in retirement. So that's the intention. Now, I appreciate if you've, quadrupled your money by holding one stock, then that's fantastic. You'll get there quicker. But if you lose it and it all falls apart and it collapses. I was chatting to a guy the other day. He's a professional in the investment management business, and he retired about 3 years ago. Only relatively young, 57, I think. And he was telling me that last 3 years he's invested quite a lot of his family's capital in business startups. And not one of them had gone well.
Ooh,
not one of them.
Ouch.
Yeah. And, and he was saying, I bet you've done much better than me in the last 4 years, but I've got out with, I've done quite well in my career. I've done this, I've made a bit of money. And I thought I was a bit, I thought I could spot opportunities. And none of those opportunities have come good so far. Let's hope that they do for him. But then you flip it and you go, okay, well, you could have been in my boring 11,000 different company portfolio and annualized 6, 7, 8% a year for the last 3 or 4 years. Well, wow, okay. I don't know that was going to happen for me, for my clients, but I don't know what will happen for him. So, but I just know that I think mine is slightly less risky. Mm-hmm. As I say, I'm never going to make a killing for anyone, but I'm not going to get them killed.
It's that word again, that risky word.
It is. There's a whole lot there, isn't there? And it depends on your expertise, and it depends on other people. And investing is really hard. I mean, so many companies have gone and disappeared from our worlds that that you probably wouldn't have bet on. I wouldn't have. When I was a 20-year-old, I was a regular user of going to Blockbusters. Mm-hmm. I'd go and rent my movie. And I understand that Blockbusters tried to sell themselves. Netflix tried to sell themselves to Blockbusters. Mm-hmm. And Blockbuster turned it down. And someone suggested to Blockbuster that you should get into streaming, and one of the directors there went, no, we make too much money in late fees. We want people to be overdue with their tapes coming back. So and look where Blockbusters is now, and look where Netflix is now. But would you have been able to call that? Would you be able to predict that outcome? I wouldn't. I'm just not sharp enough. Therefore, probably in my 11,000 company portfolio, maybe I had a little bit in Blockbuster, but I also had a little bit in Netflix. Yeah. And therefore, as I come back to, we're not going to get you killed, but we're not going to make you a killing. But we are going to, historically, as I say, we've outperformed inflation, and we've provided the cash flow necessary for providing that investment return to provide income streams of the future for retirees of the future. So yes, coming back to your question, with different people, I'm more mindful of get everyone into an equity portfolio as long as the cash flow shows that we've got enough income stream from safe investments such as cash and very short dated bonds, global, good quality, AA, AAA rated bonds in very short duration, kind of 1 or 2 years, that's what we can draw on in any down periods or volatile periods where we don't want to be withdrawing from equities.
So have an easily accessible cash stroke bond portfolio as well. And how long would you want that to be able to last?
I'm pretty conservative. I like 5 years.
Right, so 5 years worth of accessible, 5 years worth of income, accessible income.
And this is what drives the investment bit without a doubt. So if I know that I've got some guaranteed pensions coming in, and again, nothing's got absolute guarantees, but let's say someone's in the, I'm advising someone at the moment who's got a TfL pension, Transport for London pension. Now, I asked them the other day, how secure do you think your pension is going to be in retirement? And they feel it's pretty secure. It's a civil service pension. Therefore, as long the government should be able to keep paying that. So therefore, you kind of go, well, that's a kind of proxy for cash. I.e., if they're going to get a £30,000 a year pension from TfL, then you've got to go, well, I think that's probably going to carry on paying. So that would reduce if I know that they're only spending 40,000 a year, but they've got 30,000 a year coming in from their guaranteed pension, I would say I've only got a shortfall, haven't I, each year? I've got to index it with inflation, etc. But over a 5-year period, I only need to have £50,000, maybe £55,000 for the inflation risk in the bank. Mm-hmm. Therefore, I can then afford to have my investment portfolio with a higher equity content because I know that I shouldn't be tapping into it for at least 5 years. Mm-hmm. And of course, we remodel that every year. So depending if the stock market's gone up, then we might replenish the cash. If the market's down, we may not replenish the cash. And therefore, we will continue monitor how much cash should we have at any one moment in time. Has expenditure gone up? Is it more than we thought it was going to be? Has a pension fund fallen into the pension protection fund and you're not getting as much as you thought you were going to get? Well, there's so many things coming into play to drive that well-crafted investment portfolio. How much? Where are we actually putting the money? And therefore, based on historics again, what's the most likely outcome?
Yeah, absolutely. No, that makes a lot of sense. That's all really clear. So I've just probably got just one final question before we wrap up is if our listeners are looking to or considering their investing for or in retirement, and they're looking to work with a qualified financial advisor, what should they look for? Is it specific qualifications? Is it a specific approach? From your point of view, I appreciate that's just your point of view, but what would be your recommendation on what they look for when they're looking to work with an advisor?
I think it's all about, do they really understand me? I mean, you've got to get some faith that the investment portfolio that they're putting together. I'd ask for some kind of like, well, can you show me this has worked in the past? Now, the problem is, of course, is that the future is not like the past. I think it was Mark Twain who said, maybe Mark Twain, I don't know. The history doesn't repeat, but it does rhyme. I might have got that totally wrong, but I think the statement's right. So, we wouldn't have predicted this pandemic. We wouldn't have predicted, I've often said we wouldn't predict that Trump would be a president and Boris Johnson would be our prime minister. I mean, I just wouldn't have predicted this stuff. But it doesn't mean you can't work in the world. So when you're talking to someone, if they are sitting there predicting stuff, I'd just be a little bit careful. If they say, I've looked at this and I think that, historics don't always work. We know this with Neil Woodford, the star fund manager done fantastic performance over many, many years. And then the fund has collapsed. So it's not all about, I think we need to take away the layers and actually, from our way of investing, we even remove the personality of the fund manager. We use a lot of passive investments that just track markets. We use investors who are really using a kind of algorithms to just work out that they're going to buy certain parts of the market that we understand. So it's not about gut instinct and us trying to go, I've analyzed these companies and I know that Blockbuster's going to outperform Netflix or Netflix going to outperform Blockbusters. Because with all honesty, if people really knew that, then I wonder why they'd share that knowledge. So I don't know, just make sure that they really understand you and where they can demonstrate that their well-crafted investment plan absolutely fits your desires, your hopes, your plan going forward for the things that you want to do. It is hard because also I don't know how everyone else is doing this work. I know there's a number of advisors who have a very, very similar philosophy to me around the investment piece. It's a tough one, but I think just make sure they really, really understand and they can show how the investment plan, how the investment mix matches their financial plan.
Yeah, absolutely. And it's one of these things that unfortunately we don't know whether we've been advised well until probably quite a long way down the line, do we? Sometimes it's a very difficult scenario in that respect.
Yeah. And I'd just be really careful about, we're all doing these risk assessments and FCA wants to do this. It's all a box ticking exercise and it keeps people compliant and it makes, I don't, the other flip side is that even in a is we also probably don't need to take too much risk. I often wonder whether, I don't know, someone says, oh, I've got a really hot thing and I want to make, I don't know, it could be a classic thing with Bitcoin or something at the moment. And, I'm going to make, an extra 10 or 20%. And as you know, for a lot of our clients, it kind of wouldn't make any difference. But the pain, the pleasure of gain is not worth the same as the pain of loss.
Yeah, the pain of loss is significantly greater than the pleasure of gain, isn't it? And that's scientifically proven, isn't it?
It is. Yeah. It is. And therefore, just because we made an extra £5,000, really did it and how would that change your life will be the question that I would ask. So if we do make this extra return that is from this surefire thing, that the hot horse at the 3:30 at Haydock, which comes in at 20-1, and you win £20,000, and you think all the bookies hate you. Actually, significantly, how does that change your life? If it does, it significantly change your life. Again, there's a reason probably not to do it, because of course, if you lose that, then you can't recover from it. Can you recover from the loss? I know, and I think that with 11,000 stocks in our portfolio, that the likelihood of them permanently declining in value, never to return again, seems to me well, at that point, I know that capitalism has failed, and we just need. At that point, we've got a different system anyway, and we've got other things to worry about. People. The one thing I'm really passionate about is people losing money. I don't want them to lose money, and they're losing it through unregulated investments, people promising more than they can really, provide. They get into, forestry schemes, and they get into, in some crazy country, they get into hotel schemes in the Cape Verde Islands. They get into, Lithuanian mining stocks. We don't need to do that stuff. Stick to regulated, vanilla, boring equity investments, because historically they've provided a great return and beaten inflation and allowed people to sleep at night.
Yeah. And I mean, it's obvious your passion for this is obvious. And we've talked for quite a long time on this episode because you are so passionate and care so much about people investing well in the way that's right for them. So that's come through with your passion and your energy today. So that's great to hear.
Good. Well, as I say, I think if more people could invest for longer periods of time and get good investment advice, I think also possibly for the younger people out there, actually, who probably don't need to pay the expensive fees of someone like me, I can add value in so many areas when people have got complex affairs. It's not just the investment piece. The best investment to me, in fact, I was saying this to Francesca, our 23-year-old who's been with us for 6 months now, saying the best investment she can make is actually in herself and her own skills, because in herself and her own skills, she increases her earnings capacity. So in your 20s, that's what you should do. Maybe your 30s, man. You never know. I never stop in that front. And then once you've done that, is then go, okay, so now I'm if I can increase my earnings capacity, that's the best thing. And then live within your means and save money. And then the final thing, if investing is going to be part of your life, which I hope it is for so many people, is read a few books. Read around the subject. And actually,
anything you'd recommend on that? Are there specific books you'd recommend? We can maybe put them in the show notes.
Let's do that, because to be honest, the stuff I read now is probably just way, I don't know. We'll put a show notes link into the interview that I did with Professor Dimpson.
Yep.
Which we talk quite a lot about investing, and he Professor Dimson, along with a few other professors, come out with a yearbook about investing and where the returns have come from, etc. I have a copy on my shelf, and I get the updated PDF every year. But it's
and that's linked in. That's linked on that episode as well, actually. So we can provide the link to the episode and to the download.
So again, your best investment could be additional learning, and exploring. Exploring some of the really, really successful fund managers. Again, this is not a recommendation, but they do form part of our portfolios. I'd pay a lot of close attention to a company called Vanguard, and read about the story behind Vanguard and where they came from. And for an awful lot of people who haven't got complex affairs, they probably wouldn't go far wrong if they just spend a few hours learning about how Vanguard invests money, why they do it, why they were set up in the way they did it.
And you interviewed Neil Cowell from Vanguard, didn't you?
I did.
So we can put a link in the show notes to that episode as well. So that's perhaps a good starting point.
Yeah, absolutely. And we've had the other fund manager I like, which is not available to direct to consumers. It's only available to specific advisors in the UK, me being one of them. But there's another company called Dimensional and we had David Jones from Dimensional UK on another podcast talking about their way of investing as well. They they were one of the first index investors. They want to create their founders created the first index funds. So index funds form very much part of our kind of bespoke boutique portfolios that we put together for people. If you haven't got an advisor and you're looking to learn and to have a successful investment experience, control your emotions, control your fees, and maybe spend a bit of time understanding how investments work with Professor Dimson's book, looking at the Vanguard approach. And you can read an awful lot from Dimensional as well on their academic evidence to investing. As I say, these approaches won't shoot the lights out. They're not going to be the top performer. But it's highly unlikely they're going to be the bottom either. Therefore, what are we really trying to do? We're trying to have the right engine to drive your car from here throughout to your death day, and the engine is this well-crafted investment plan. And that's probably not something you coming back to my tree analogy. You don't need to swap the engine in and out every time you get to a service station. You just need to let the thing run and service it well, look after it, put the right fuel in it, care for it, and let it do what it's supposed to do.
Great. So there's lots of links there we're going to put in the show notes, because David Jones from Dimensional has been on the podcast twice, I believe, as well. So there's a couple of episodes there, which again would be a good starting point. So we've got lots of links we'll put in the show notes, which you can find on the website, retirementcafe.co.uk, and also on the show notes for any of the podcast players. So we'll make sure that's all included. That's great. Thank you. Well, I think that's quite a lot of information all around well-crafted investment. So thanks for that, Justin.
My pleasure. Thank you to Kathy for helping me explore investing today. I hope this was helpful. If any questions have popped up for you as you've listened or watched, please don't hesitate to get in touch and I'll do my best to answer. You can reach me on email at hello@theretirementcafe.co.uk or via Twitter at JustinKingCFP. So check out the show notes for links to what we've discussed today, as well as previous episodes in the 9 Accelerator series. Next in this series on the 9 Accelerators for a successful retirement is Asset Allocation. To be sure to subscribe to catch that episode when it's released. I know that some of our listeners prefer to watch my conversations, so you'll find a video version of every episode on my YouTube channel, Justin King MFP. You'll find a link in the show notes on our website. If you watch on YouTube, make sure you subscribe and hit the bell symbol to receive notifications every time we upload a new video so that you never have to miss an episode. As always, if you've enjoyed this podcast, please leave a review on Apple Podcasts to help more people like you to find us, or share this episode with someone you feel will benefit. So until next time, this is Justin King helping you feel more informed in your retirement.